I've retired and wow, my taxes are really low. This is what someone said to me recently. And it's true. Their taxes can be very low because they are in that gap period between work and having to take their forced distributions from their IRA, those required minimum distributions. So I looked at their tax situation. Now, let's call them Bob and Mary. Bob and Mary have done everything that they were told to do as far as saving for retirement. Bob worked for a company that had a pension, which is unusual, but Bob gets a pension. They chose a lower amount so that there would be 100% continue. If anything happened to Bob, Mary would continue to get the same amount for as long as she's living. Bob had Social Security. Mary didn't work, and so she gets half of his Social Security, and then they need another $50,000 of income. Bob's pension is $30,000. His Social Security is $36,000. Mary's spousal benefit is $18,000, and they're using $50,000 a year from their different accounts where they've saved money for retirement. And if they use that taxable account, then their taxes are going to be fairly low. And let's just assume that they'll have to pay capital gains, long-term capital gains on about 24% of that distribution. If that's their taxable income, pension is 100% taxable, Social Security is 50% taxable for them under this scenario, and they pay long-term capital gains on 24% of that $50,000 distribution. Their annual tax this year, 2025, would be $2,409. That's a very small amount of tax. But Bob does have an IRA, and he will have to take distributions from that IRA in the future. And so if he doesn't do anything and he waits until he's 73 to start taking distributions, at that point in time, the $50,000 today would have grown to $80,000 required minimum distribution. And that's just assuming 6% growth between now and then, just to come up with a figure. If he has to take $80,000, he still has Social Security, he still has the pension, then his tax in that first year, first required minimum distribution, they're going to pay $19,675 in income tax. That is a huge jump. And it's one that they're not thinking about or weren't thinking about because they were just looking at the fact that they've paid so much in tax all this time that Bob's been working, and now they've got low taxes, they're retired, that's great, that's what they expected, and yet this future required minimum distribution is ahead of them. So they really need to do some planning between the time that they retire and when they're going to start those forced distributions, the required minimum distributions that they have to take. If they can make some shifts, they can reduce that future tax on those required minimum distributions. Let's say that they start taking $50,000 a year from their IRA currently, either to spend or to do some Roth conversions, whichever the case may be. If they take $50,000 from their IRA this year, then their tax is going to be $10,647. That is more than the $2,400, but it's half of what they will have in the future. And so they want to do some planning, do some shifting, think about it so that they can keep their tax level over their lifetime, as opposed to having a very low tax for a number of years and then suddenly have it shoot up, rocket up to a much higher tax and be stuck in that higher tax bracket then for the rest of their life. This is why tax planning is so important. You've got to look at your situation in the current year and over all of your retirement years. And if you need some help, get some help from an advisor that can work through what should you do and when should you do it to be in the best position over your entire lifetime to minimize that lifetime tax bill that you're going to have. So I hope that's helpful, gives you some food for thought, helps you begin to do some good planning in 2025 so that you can be on your best path for your retirement.